Good day, ladies and gentlemen. We are Team T and we're glad to present you our investment idea. Russia's largest food retailer, Magnit. Magnit is a blue chip stock and one of the top 10 largest companies in Russia with market capitalization of $17 billion. We see 15% potential upside to our price target of 11,804 and recommend buying the stock based on strong fundamentals and attractive valuations. Before we will dive into company-specific details, Vladlena will give you the overview of the industry.
The size of the Russian food retail market is 12.7 billion rubles. We project grocery retailers to increase sales at average annual 3%. The structural factors of Russian retail market are the most influential. The first one is the emerging economies of scale. For example, logistics, which is crucial for expansion in Russia due to large country territory, low population density, and poor road infrastructure. The second is the market penetration. Modern stores account for up to 53% of the market. We believe the growth potential of modern formats is more than 25%. The third is the market concentration. The top 5 players only have a market share of around 20%. And finally, the Russian selling space density is 1.5 times lower than in European countries. Russian households had an average of 4.3 food stores within walking distance. All above-mentioned factors show that the Russian retail food market is low penetrated, low concentrated, and gives a great opportunity for growth and development.
We see Magnit as offering the highest quality exposure to Russian food retail space, and we believe that any meaningful share price weakness may offer a good entry point. So, there are 4 investment drivers supporting our positive view on the stock. High growth potential, which was already mentioned, strong business model, attractive valuation, and good corporate governance. We expect that in 5 years' time, Magnit will double its market share in Russian food retail from 7.7 to 15.4% in 2020. We highlight substantial consolidation opportunities in the sector where largest players, Magnit, X5, Dixie, and Lenta, still have a relatively small market share. We investigated Magnit corporate governance by using the OECD methodology and obtained the results 8.5 out of 10 weighting each criterion. Thus, the Magnit corporate governance meet all the necessary requirements and most of the recommendations of the OECD, although the company takes into account only the principles of the Corporate Governance Code of the Bank of Russia.
Magnit is Russia's largest retail company with a share of 8% of the market and one of the largest employers. Magnit went public in 2006 and currently 56% of its shares are traded on London Stock Exchange and Moscow Exchange. Magnit conducts a profound segmentation of the existing markets and considers customers with different income levels, offering a multi-format business approach. Neighborhood convenience stores, hypermarkets, Magnit Family, which is the combination of the first 2 formats, and cosmetic stores called drogeries. Magnit covers 7 federal districts of the Russian Federation. 2/3 of the stores are located in small cities where there is no competition from other retail chains. Magnit has an extremely high centralization ratio of 90%. The company has a great influence on future profitability through the development of innovative logistics systems, improving contract terms with suppliers, and optimizing the store range. Magnit strives to maintain high levels of profitability and internally generated funds. Historically, it had the highest EBITDA margin in the industry. The company's cash flow from operations are expected to allow covering all the capex needs. Cost efficiency and maintaining low prices for customers through cost control are among Magnit's key aims. The company also uses big data concepts and tests e-commerce services to keep up with the times. To sum up, let's take a look at Magnit and its main peers. Firstly, Magnit has already occupied all the strategic locations in most of the regions. Secondly, Magnit has the best logistics systems in Russia, which is crucial for its further expansion. Moreover, Magnit is able to finance its growth internally, without any debt. And finally, Russian people are very price sensitive, so Magnit tries to have the lowest prices in the industry.
Valuation confirms our strong buy recommendation. We applied 2 methods: free cash flow to firm and the multiples analysis. DCF appropriately reflects the high potential for the future growth of the company, while the multiples analysis fully highlights current market sentiment. We have identified the following key assumptions for our free cash flow model. The first one is current aggressive expansion through new openings. We believe these openings will drive Magnit sales growth of 20.2% CAGR through the forecast period. The second assumption is we expect that Magnit should be able to increase cash flows by 7% into perpetuity. The third assumption is our cost of capital. Risk-free rate is based on the current yield of 10-year government bonds. To find beta, we regress the returns of Magnit with the MySix for 3 years. Risk premium is calculated as a default spread between the equity and bond risk premiums. The capital structure is based on company's guidance. We believe these fundamentals will generate strong EPS growth of 23.1% during the forecast period.
The comparative valuation method confirms the buy recommendation of DCF analysis. Magnit has significant premiums to Russian peers, however it trades with discounts to the emerging market peers. The intrinsic value for share price using the 2016 forward-looking EV/EBITDA multiple for Russian and emerging markets is equal to 11,406 rubles. Combining these two models and assigning to them equal weights, we achieve the local share target price of 11,804 rubles, with an upside potential of more than 15%.
The average ticket forecasts are based on the inflation, though in 2015-2016 it will grow slower due to toughening competition and cannibalization effect. Steady sales growth and increase in in-house production will contribute to Magnit's key margins. We expect EBITDA margin and net profit margin to fall to 10.3% and 5% respectively in 2016, and then experience positive dynamics because of creeping macro recovery and customers' demand revival. Capital expenditures will be driven by building its own stores or leasing, accompanied by building new distribution centers. We assume the dividend payout ratio being at a level of not less than 44.9%, with the increase to 60% in 2019 and thereon, as Magnit will not possess long-term debt. We have projected Magnit's return on equity to decrease to 30% in 2017 because of falling net profit margin, and then grow again due to retained earnings rising slower than net profit.
Having considered the Magnit's upside, we also considered the downside of the stock by taking a look at the operation and valuation risk. Let me draw your attention to the three most important risks. The first is the legislation. As we know, the budget is in deficit, so the government may try to close the gap with the increased taxes on corporations. Furthermore, according to the Federal Law 381, the decrease of supplier bonuses may have an adverse impact on gross margin. Secondly, the lower demand for Magnit's products. Real wages have not increased from 2014, while the prices experienced almost 20% inflation. Magnit mitigates this risk by having the lowest prices in the industry, maintaining the flow of customers at the pre-crisis level. Thirdly, aggressive expansion plans from its competitors. Although the Russian market is not penetrated, Magnit's peers have aggressive strategies for 2016. We expect that the industry will become more competitive and even price wars may take place. Moving on to the valuation risks, the terminal value accounts for the major proportion in our DCF model, primarily driven by the sustainable growth rate. We ran the sensitivity analysis on it, and what we discovered is that there is only 5% chance that will trigger a change in our recommendation from buy into sell, in which case the loss is still very limited. On the other hand, the probability of gain is as high as 65%.
With the four reasons of being the growth stock, company has high growth potential, highly rated corporate governance, strong business model, and attractive valuation. We have concluded that Magnit is a stock that definitely should be in your portfolio.